Welcome to Season 2 of Grain IQ. I'm your host, Chad Moyer. Grain marketing is a critical piece in keeping your operation profitable, and in Season 1 of Grain IQ, we covered the basics of grain marketing. Season 2 dives a little deeper into these grain marketing concepts that we covered in Season 1, so if you haven't listened to that, we invite you to start there. This is Part 2 of our topic on puts and calls. In Part 1, we learned the basics of trading puts and calls. Now today in Part 2, we'll kind of put the rubber to the road and work through some of the math when it comes to options trading. Doug Simon joins us for today's conversation. Doug is a commodity consultant with Tredas in Lincoln. Well, I think we've talked about the theory of the options to the point where we've got it defined. At least we have an idea of what they are and how they work. I think this is the point now where the rubber meets the road. So let's do some math problems. Let's do some examples of how producers can utilize an option and how it protects them. Again, we're going to come at this from a farmer perspective, producing a crop, producing a commodity, and then using options in their risk management plan. So with that in mind, take us through a scenario where we would be marketing grain in the fall. How would you use options and how would that look?
Right. So if you want to start with the example of, say, the puts, if you're doing that maybe in the springtime, and where, again, you'd be looking at, say, if you're going to raise 100,000 bushels of corn and you're trying to protect 70% of it, we would probably look at buying puts in kind of that, February's time slot. We tend to like to buy them whenever there's strength in the futures market within those incremental time frames. So maybe we're going to look at buying some in February, March, April, May, June. So you've got 5 slots that you're going to buy in there on. So if you look at over 70,000 bushels, you might say, okay, I need to buy 15,000 bushels of puts each month. So if corn price was at $5, back in February, you could look at buying a $5 put, or maybe you've got to buy something that's slightly out of the money, maybe a $4.90, $4.80. But again, you're going to be looking at holding that, into the fall. So the question is, what you do? This is going to open another can of worms, whether you're going to use the December futures or you're going to use some of the short-dated options. You can use now what they call short-dated options versus the December futures. The December ones expire in November, but they've come out with ones that give you expiration basically every month: March, April, May, June, July, August, September. That allow you to not spend as much time value on them, but you can still put a floor underneath them. Mm-hmm. And so we do definitely use those options. So in February, you might buy some against the May, mm-hmm. but you would pick, one of those things is going to expire. So, and that's where you could buy those puts in there to put a floor underneath it, but you might do them like in strength in the market in February, whenever because the markets never go up and, straight up and down,
there's a trend.
There might be trends, like this year we trended higher, but there's ebbs and flows in the market. So whenever there's strength, we tend to try to, either hedge or buy those puts. Mm-hmm. So you'd be looking at that. So that $5 strike, for example, going all the way out to December, I can't remember what those things were worth last February, but they might have cost 20 cents at that point. In February, the volatility was still pretty low.
Yep.
But so it basically allow you to put a floor underneath it. So if the market went back to $4, that put should have been worth from 5 to 4 should have been worth $1, and you spent 20 cents on it, so you had a net gain of 80 cents on it. Now, in this case, this year, the market went from 5, like the February price average for crop insurance was $5.90. So instead of being at, 5, it went to $5.90. So there, your 20-cent option would have expired worthless. And then, we would have been at $5.90. Now,
but you would have participated in the market up here.
Right. So so you could have turned around at that point. So say if you'd done it against the May short-dated options, and so February we're at $5.90 average price, and then into March and May we went, into the $6-7 realm. So in that case, instead of having hedged at $5 and you bought the $5 put, you would have been able to trade into that higher market. Say if it went to $6.50, for example, and your option expired in May, then you could have let that thing expire. You could have went into the futures market and sold $6.50 corn. Mm-hmm. So you would have locked in $6.50 and taken the 20-cent loss in your option. You would have had $6.30. So $6.30 is much more preferable from a net margin standpoint or a net mm-hmm. gain on my, versus the $5. So that's where you're able to trade into a higher. And this is a perfect example this year with the uncertainty with the war and with kind of looking at La Nina, what's going on in South America, to put a floor underneath it to be able to see if we could get an opportunity to sell into a higher market. So this year, put options work, really well in that sense.
So the options have a place.
Absolutely.
Either way, if the market ends up going higher through the year, or if it more often, like a seasonal pattern would tell you, it goes lower.
Right.
An option is protecting you either way.
Right. Absolutely. It gives you some flexibility. As I was saying, as you kind of peel this back and try to figure out what you're going to do, it allows you to kind of slow down the market, but also gives you that flexibility in the event that things, 75% of the time we tend to go down, but there's 25% of the time we do go up, and it's because usually there's drought or there's some type of, like situation that went on this year that drove markets higher. Yeah. You can't predict what those things are going to do.
Do you have to have a futures position in order to use an option as a marketing tool?
You do not. You can use options independently. Futures trade independently, options trade independently. So if somebody doesn't like margin calls, for example, if they, if you hedge and they're afraid of, the board going from $5 to $6 and having a margin call, we can talk more about crafting a marketing plan. Well, I don't think that's a big problem, but but having that, you can trade that option. Or say if you'd gone out and done a cash contract, let's use that $5 price, for example, that we used. Maybe you did cash sales, maybe you wanted to deliver wet corn to a feedlot, and you knew you had to go in that time slot. There was no debate about it. I wanted to take wet corn in there. I sold $5 corn, but if I wanted to you could buy that call option to go with your cash sale that you made. So you made a futures decision because you sold cash, but it wasn't in your futures account. It was with somebody else. But you could buy that call option to go with your futures decision that you made through a cash sale to leave that open in case something changed like it did this year with weather and the war, to be able to trade into a higher market. So if, say, we sold that cash corn to the feedlot at $5, bought that $5 call, say we did it against the May short-dated future options. So maybe I bought a $5.50 call, and then the market went to $6. So say if I spent 20 cents on that call and market goes from $5 to, say $6.50, and I bought that $5.50 call, which is a little bit out of the money, or would have been 50 cents out of the money, bought it for 20 cents, I would have had basically a $5.50 to $6.50. I would have had $1 gain in the futures, or through the option, excuse me. And so I spent 20 cents, so my net cost was 80 in that case. So then my cash selling price was $5, and then I take my option gain and I put the 5 plus the 80, and I enhance my price to $5.80. It's not $6.50, but it, from that decision point, okay, when I'm making those decisions back in the spring relative to what I bought my fertilizer, where's my margins for my farm? Okay, is that $5.80 a good selling price? Yeah, it's a great price. That's where you have to have your mindset about what's a good price. But that's an example where you wouldn't have to have a futures. You wouldn't have to make a futures decision in your own account. You could do a cash sale and use the option to enhance it.
Now, this next question, this is going to be a little bit more advanced, and you and I had talked about this before, but there are strategies out there where you can use puts and calls together that give you a range where you could participate in the market, right?
Right. Yeah, you're right. This is going to be more confusing. So if you buy a put, whenever I do something in a futures market, there's always a buyer and there's always a seller.
Yep.
So there's two people on that side of the transaction. So that's where it gets confusing. And so say if I want to buy a call because I think it's going to go higher, somebody else is saying, well, I'm going to spend 50 cents for a soybean call, to go higher. Somebody's saying, well, I don't think I think I can sell that premium and keep that for myself. So there's traders in there, market makers that are operating in there all day. And sometimes we'll go in and do that same thing where we'll perhaps, buy a put and then put it together with you buy the put and like sell a call. So you would, again, I want to keep this simple. It's like if I'm going to buy that $14 soybean call that I've been talking about, I can also go in and sell that $14. So if I bought it for 50 cents and you sold it, you'd get to keep that 50 cents. But I would have the opportunity to buy it $14, but you would have the obligation to sell at $14.
You wouldn't have, even though when you sell an option, you don't have the opportunity or the flexibility. You have the obligation, the commitment. If you sell at 14, you're going to sell $14 futures. You're still going to keep the 50 cents. But if the board goes to $15 as the seller, you're going to keep your 50 cents. So now you're going to be short at 14. The market goes to 15. You've got $1 loss you're going to get an actual futures position. You're going to have $1 loss. You're going to keep your 50 cents. You're going to about 50 cents. So from a farmer standpoint, like that example I gave you earlier where I bought maybe a $5 put, I could maybe put a $6 short call with it. So I'm buying the put to have the opportunity to be short at 5 or be able to sell at 5. But if I sell a call, so whoever's buying a $6 call wants to be long at 6 or be able to have that opportunity to go from 6 to 7. But if I sell that $6 call, I'm going to be taking the other side of that. I'm going to have to sell futures at $6. Now, is that a bad idea? I think, sometimes when you buy those puts, you'll sell those calls above there to get the cost of buying that put down to reduce your net cost. So I might spend 20 cents on the $5 put. I might go sell a $6 call for a dime. So my net cost now of my $5 floor is 10 cents, which is a lot cheaper than 20. But I would also have the obligation to sell corn at $6 if it goes up there.
So you just have to make sure that if you're going to do that, what portion are you protecting on this side, but what other portion might be vulnerable?
Absolutely.
If you get to the top.
Absolutely.
And you're a forced seller.
So that's where your mindset and thinking about any future strategies or option strategies come into place is like, what are the consequences of what you do? And that's where I think in terms of risk management and crafting a marketing plan is like, you have to understand if you're going to use options or if you're going to use over-the-counter transactions from elevators or any of these different things, but what are the consequences of what are you doing? And we spend so much time trying to help people think about those things. If you're going to go and buy that put and sell the call, what does that mean? You have to really understand that you're going to be short at $6. So if it goes from 6 to 7, like it did this year, you went way above your $5 floor, but you're now selling $6 corn. You could be hedged there, which if that was your first sale this year at $6, that's a whale of a price. And if you were able to keep selling into the 6 and 7 and 750 market, and that happened this year, whether you're using options or using futures, you could come up with a much higher average price. I think the average price of corn between February and June was $6.80. So now we're at $6.05 or $6 on this day. So we're running 80 cents below that seasonal average price that you could have sold basically February through June. So if you got hit at $6 and maybe you were crafting these and laddering, they're called a fence where you're buying a put, selling a call. But if you'd put those on at different times in February, March, April, May, and you were maybe selling $6 puts and $7 calls, and maybe you're buying $6.50 puts and $7.50 calls, but depending on where those expirations were, you might have been getting hedged at $6.50, $7.50, which actually now in hindsight, that was a beautiful marketing plan because it gave you some flexibility to trade into those higher ranges.
Yeah.
So it's how you craft that and being so aware of. That's where over time, I've been a broker for 22 years and used futures for 12 years prior to that, and people don't always understand the kind of the commitments or obligations of a futures, but also those options when they're doing with it, and so that's where people try to get the cost of those options down, so they go out and they sell options. You got to just be, like I heard a strategy the other day where you're buying put and you're double selling calls. Well, what's that mean? So how's that going to work? How's it going to work? You got to understand it. So.
Yep. All right. So I think we've got to the point where we've got the basics. I think we've laid out what they are, how they work, and things like that. As we wrap up, is there anything about options that we haven't covered that you think is important that a farmer understand about how it is part of a marketing plan?
I think we've covered the buying the put to protect your, put a floor underneath it, and then if we're going to hedge, buying the calls to go with it to give you some flexibility upside. I think those are two strategies that are very, very important. I think when you craft that plan, for dryland farmers, say in eastern Nebraska versus irrigated farmers. I mean, where you've got more production risk as you go into, say, western Iowa, where you have more, like in this dryland areas, you have a lot more yield variability. So I think, again, it's probably lean a little more making sure I've got optionality for somebody that has more variable production. I think that's key. Irrigated farmers, obviously this year we got really hit hard by hail, had really bad, wind, but there tends to be more consistent production. But using those options definitely, I think, are more important for people that have more variable production. I think that helps, and using that in conjunction with your crop insurance. So I think that's when we talk about these things. A lot of the concepts I talked about, seasonality, and a lot of that stuff's based on the crop insurance theory at K-State and stuff Bill Turney and Bob Wisner did, where you have your springtime price in February and your fall time price in October. So there's a lot of these things are kind of fitting together, how you craft that marketing plan. So I think doing that there's definitely an art to that, and doing it in a way that kind of fits your operation. And in our group, we spend a lot of time want to know exactly what we're doing the year, how that pencils out at the end of the year, and keeping track of like cash sales and using options. So I think that, again, how you put those things together, and that's where I think it helps to have somebody that's seasoned and having the experience of kind of dealing with a lot of different markets, and what's the best option to use at the time, and how it fits, and what's it going to give you.
Yep.
So I think that's critical.
Okay. Doug, final question. When you peel back all of the layers, when you get down to the core of using options as part of your risk management plan, why is this important to farmers?
I go out to farms and I talk to people and I tell them, if I knew where the market was going to go, I wouldn't be sitting out here. I don't want to come out here and blow smoke and act like I can predict what the market's going to do, because I don't think anyone can predict what the market's going to do. And so by using options, it allows you to make a decision, but also to come back and to say, okay, hey, there's things that changed a little bit, and I can make some adjustments in my plan here, and I can still keep it with my same plan and not have to jump around a whole lot. So I'm not in and out of the market trading every day. I'm not calling up people, let's buy corn or let's sell corn. It's more about, okay, what's my long-term plan? We don't go out and change our row spacing every year, and we kind of have some things that we do year in and year out. So I think a marketing plan, you have a lot of consistency, but those options kind of help you, I would say, micromanage some of those market moves and slow down the market and give us more, allows you to sleep straight at night.
How do we follow along with what you guys are doing? And again, kind of building these layers and putting it all together. How do we follow what you guys are doing? Tredas,
you can find us at gotredas.com on the World Wide Web. You can find us on Instagram, Facebook. I don't know if we do TikTok. I'm the old guy in the group. Instagram,
Twitter?
So Twitter, yeah. So we try to post every morning a morning minute, and we do kind of a outtake after USDA reports, so you can find us there. We send out at the end of the week, we send out some commentary. We can send out to people if they kind of want to get a flavor of what we're up to. But you can go onto our website and see a lot of different testimonials. Our business, we work in Nebraska, probably about 70% of the people we work with. We work in western Iowa, a little bit in Kansas, South Dakota, but usually within about 4 or 5 hours, Lincoln is where the bulk of the people. So we trade a lot in this market. We do a lot of cash grain marketing. A lot of us had merchandising experience, worked on an agribusiness. We've got farms and use crop insurance on our own farms. So we kind of eat our own cooking and craft this stuff for our own families. So you can find us and learn a little bit more about us on there. And because we live and work in this area, we can come out and see and sit on your farm and see what's going on.
Absolutely.
That's important.
Again, joining us on today's program, Doug Simon, a commodity consultant with Tredas in Lincoln. Thanks for listening to Grain IQ. I'm Chad Moyer.
Grain IQ is a production of the Nebraska Rural Radio Association with support from the Nebraska Soybean Board. It is brought to you in part by Nebraska soybean farmers and their checkoff. Grain IQ is hosted by Chad Moyer and produced by Rebel Saklocha. It is written and edited by Alex Wojcicki. Our project manager is Bryce Duskett. You can listen to Grain IQ on Spotify, Apple Podcasts, or online at ruralradionetwork.com.